So wait a second. You're making the case that because you wore a shirt and showed off your chest, that got us more views than any other episode?
Right, because the one before that, both AJ and I showed up with that shirt, and it was one of their best episodes yet. So clearly it was the shirt. The question was it AJ's shirt or my shirt? And so then we did the experiment. I called it out, and sure enough, that was our best episode. I think our second highest 1 week episode ever, and it was because I had the shirt and AJ didn't. So
he wanted me to wear a turtleneck because he's so worried about my chest overshadowing his chest.
Welcome to Drunk Real Estate.
Grab a drink and enjoy the show.
Hey there, and welcome to episode 45 of Drunk Real Estate. I am Kyle Wilson, Ashley Wilson's husband. And guys, I appreciate you waiting for me. I made it a little bit late, had some issues, but better late than never, right? How's it going, Jay?
Doing okay. A little bummed. So I was talking to Mauricio. So every year for the last
and that's why you were bummed, because every time you talk to Mauricio,
yeah, that is part of it. No, we're having this conversation. So every year for the last literally 20 years, my friends and I go to Vegas for the World Series of Poker. And we missed a year or two during COVID, but pretty much every year since 2005, we've made it to the World Series of Poker. And you were going to join us this year. And unfortunately, we can't find a week that works with my schedule this summer. So I am missing the World Series of Poker this year, and I am really bummed.
Wait, you invited Mauricio to join you?
I don't remember first of all, I don't remember getting an invite. I've been pushing for an invite for a couple of years.
Because I specifically said that would be fun. And Jay was like, this is kind of a thing that just me and the guys that I did before. And, he basically said I wasn't allowed to come. So the fact that you're inviting Mauricio, I'm not shocked, but I'm a little hurt.
That's exactly what he told me. I'm like, dude, I want in. Tell me where to be. I'll chip in. I'll buy the whatever. And he's like, well, this is really
Mauricio made me feel a lot more guilty about saying no. So I was going to relent and let him join us. So next year we can all go.
Let's do it. We can record episode 100. In Vegas,
actually, episode 100 will take place during the World Series of Poker next year. So yes, we can.
There we go.
Hey, is that if we stick to doing every single week up until that week?
Well, why wouldn't we?
Yeah. We've already recorded 3 in the can, just in case.
Jay, are you drinking anything tonight?
So I was in a rush. I've been running around all night. And so I went and grabbed the first thing, literally the only can I have in my fridge. Does this look familiar?
Oh my goodness.
Is that from the tailgate from the Bucks game against the Eagles? We're talking 4 months ago?
Yep. It's been sitting in my fridge for 4 months. Literally, it's the only can I have sitting in my fridge. So it's a Blue Moon Light Sky Citrus Wheat. That's what I'll be drinking tonight.
Did your wife get you a little orange slice just to...
My wife has been traveling for 5 days. That's why there's nothing in the fridge.
Yep.
She hasn't made the Costco run for you.
Nope.
Mauricio, how's it going, man?
Dude, this is the longest intro of the 45 episodes we've done so far. I mean, Jay just went on forever and ever. It's let's just get to it. Let's just get to it.
People like to feel like they're relating to us with our stories.
You know what the people really want? They want to get right to the shirt and the chest and everything like that. Because you guys remember from last episode, we were debating whether my button down deep shirt or AJ's was the winner. And last episode was our second best 1 week episode of all times, which clearly shows that people are tuning in for my bare chest.
Second best in views or second best on total time watched? Because I would think it'd be total time watched if they were watching just to see your chest.
Literally, it was the shortest. It was the least time watched on average of any episode was last week.
Because they saw that mine wasn't showing, so they bounced out.
No, it's not. I told you guys earlier, it's because you're taking too long to get to that shot of me with the shirt. And people just click off. They're like, if we can't get to Mauricio's shirt, then forget it. We're going to move on.
What are you drinking, Mauricio?
Anyway, I'm doing something a little bit unique. I barely have eaten today. Actually, I think I just literally grabbed my first meal. I had breakfast an hour ago. And so anyway, I'm having a little Pisco again. I brought back the bottles of Pisco, which I did. But instead of doing it with the ginger ale, because Kyle looked at me, I'm doing it with Coca-Cola. And do you guys know what this is called? A little Pisco and Coca-Cola?
Piscola.
Piscola, it is. And so I'm enjoying a little Piscola, very traditional Chilean and Peruvian drink, and it's pretty tasty.
I'll reiterate. You made it sound like it was better that you were using cola instead of ginger ale, but it's literally the exact same thing, probably sweeter. And anything like rum and Coke, Jack and Coke, anything you put in Coke is delicious. So I'm not gonna toot the Piscola horn right now. I might as well go over to AJ. He's already drinking Coke anyway.
That's right. Diet Coke, baby.
How's your shoulder?
Shoulder's doing good. Doing a lot better now. So that's nice.
For those who don't know, that don't follow him on Instagram, I don't know if you've even put it on Instagram, but a couple days ago, we get a picture sent in our WhatsApp thread of AJ in a hospital bed, and we weren't really sure what happened, but turns out that his son took him to the cleaners in basketball.
No. Wrestling. No. Alligators. There were alligators, and AJ decided to wrestle the alligators.
He saved a toddler from a shark. That's right.
Exactly.
He didn't lose to his kid in basketball.
Yeah, and you should see the shark.
Bruce, I did not hold back.
Glad you're feeling better.
Thanks.
You got the red Solo cup of Diet Coke.
Oh yeah, always.
So the Piscola minus the Pisc.
Exactly.
A Piscola virgin, a virgin Piscola. I like it.
Yes, it is. That's what I'll just say from now on every time. Oh, I'm drinking a virgin Piscola.
That actually sounds. If nobody knows a Piscola is a drink, that sounds a little bit different. But for anybody else who cares, I was rolling in like late. These guys had to wait for me, so I appreciate you. But so I just grabbed the first thing I have. And Jay, what do you think I grabbed?
Woodford Reserve. Oh, clear. No sugar, no carbs.
Yeah,
clear.
I'm trying to keep free of the carbs right now. So and you know what? It sounds so much better than every other drink when you open it. If you want to do a little ASMR here. Wasn't that good? I feel like that was good.
You know what that sounds like? That sounds like every other can that I've ever opened in my life.
No, that is wrong. It was a very special opening. All right. Speaking of openings, why don't I read the opening for our first segment? Good segue there. Let's talk about.
Are you going to start with me this episode, or am I going to go last?
Actually, you know what? I'm not even going to give you a chance to talk this episode. I'm just going to go only Jay and AJ, just because I feel like the people you're just the eye candy, Mauricio. We bring you in for people to look at. You don't even have to talk. All right. The biggest news in the market last week was the Q1 GDP slowing much more than expected. Projections had GDP coming in around 2.4, which would still have been a slowdown from the previous quarter, which was 3.4. But the actual rate came in at a measly 1.6%. Naturally, the markets panicked, as they always do. The Dow fell sharply, and the 10-year Treasury hit a 5-month high again. But once the panic subsided, new fear creeped up, new fear unlocked, in which we were talking about the dreaded stagflation. So, Jay, why don't we talk about what stagflation is and why everyone's so worried about it?
Okay. I have literally been avoiding this topic for 15 years. So everybody likes to talk about stagflation. You hear it in the news. But as far as I'm concerned, and for 15 years, I've been saying no shot of stagflation. It's a clickbait, hyperbole, headline grabbing term that I haven't really liked. But I'm going to submit that given where we are today, I am now comfortable after 15 years in this industry. And I've been right for 15 years. We have not had stagflation. So talking about it forever. But I'm comfortable today considering the idea that maybe there is a risk, maybe even more than a risk of stagflation. So let's start with what is stagflation? So for anybody that's been paying attention the last couple of years, it's been hammered into your head that inflation and the broader economy kind of go hand in hand. Specifically, as inflation increases, the economy tends to improve as the economy tends to improve and inflation increases. We see asset prices go up. We see wages go up. We see housing values go up. Everything we've seen over the last couple of years. Now, historically, inflation starts to kick in when an economy gets really hot. Basically, you have a run up, the economy gets better and better and better. And finally, the economy overheats. You get a lot of inflation. And at that point, the Fed has to slow things down. So what they do is they increase interest rates. They expect that increasing interest rates are going to cause inflation to decrease. The economy will cool. And then most of the time, we're going to end up in a recession. That's what happens nearly every time. But it didn't happen most recently. We increased interest rates from essentially 0 to over 5%. Inflation did start to come down. but it kind of petered out. And so this puts us in a situation while typically inflation is bad. We don't like to see too much inflation for obvious reasons, but it means an economy is good. And recession is bad, obviously, for the same reasons we don't like to see a lot of recession, but typically recession means that we have low inflation. So generally we get the benefit of one of those things. We either have a good economy or we have low inflation. But we always get the negative thing as well. If we have a good economy, we typically have high inflation. If we have a bad economy, we have low inflation. So those two kind of work against each other. Now, imagine a situation where both things are bad at the same time. We have a recession and we also have high inflation. Well, that's stagflation. And obviously that's bad because recessions are bad and inflation's bad, and the two together are super bad. But here's why it's really bad. How do you get out of a recession? Well, we've already talked about the fact that the Fed uses interest rates to control the economy. To get out of a recession, we lower interest rates. That spurs the economy. It gets people spending. But if we experience a recession at the same time that we're already seeing inflation, well, at that point, lowering interest rates might get us out of the recession, but it's almost certainly going to drive inflation up at the same time. And so that puts the government in a really tough spot. They have to choose between, do we lower interest rates and get out of the recession, or do we increase interest rates and increase the chance of the recession or hurt the recession? And historically, I don't know if people know this, but historically, the government's chosen recession. So historically, when inflation gets too high, we raise interest rates. We go into a recession. It's not good. We have 6, 12, 18 months of crappy economy, and then things reset and we keep going. And if you look back, let's say the late 60s, 1970 to 1982, we had 4 recessions because inflation was so high. So the Fed just kept rates high for basically 12 years, which caused 4 recessions. The Fed chose recession over inflation. Well, here's the problem. Today, it's unlikely the Fed is going to choose recession over inflation. If we start to go in recession, I think it's clear to all of us that what the Fed's going to do is they're going to start lowering interest rates. And if the Fed starts lowering interest rates, like I said, what's going to happen is we're going to see inflation run away. So it's actually worse than this, though. So in a typical...
You're saying that like a definite, though, Jay. Is that what you're convinced, that if they lower interest rates, we're going to see inflation run away? Or are you just hypothecating that could happen?
We don't know. And again, I don't know that
Jay
we're going to see...
Jay's got the special crystal ball. He knows exactly.
No, I'm asking what he believes, though. Is that what he believes?
Well, the reality is that so far inflation has been sticky. I mean, we got from 9 down to 3%, but now we're heading in the wrong direction. We're closer to 3.2, 3.3%. And it doesn't look like interest rates are going to impact inflation, or increasing interest rates is going to lower inflation. But lowering interest rates, there's a lot of demand out there. There's demand out there for housing. There's demand out there for other assets. There's demand out there, obviously, for stocks. Stock market's going through the roof. So I think lowering interest rates is likely going to increase inflation. But it's actually worse than that, because if you think about it, why do we have a recession? We have a recession because we have debt. And so think about a typical person. If you have a little bit of debt and you lose your job and you kind of go into let's call it personal recession, things are bad. If you have a lot of debt and you go into a personal recession, you lose your job and whatever, things are a whole lot worse. So having a lot of debt means the recession for us as regular people is going to be worse than having a little bit of debt. Well, I would submit that translates to the government as well. When the government has a little bit of debt, a recession is not good. It's bad. But when a government has a lot of debt, that's just going to make the recession even worse, because the government's going to have to monetize more debt to pay their interest, to basically helicopter money to people. And it's basically going to make things 10 times worse. So I think the fact that we are in such a bad debt position, deficit position, debt position, Fed balance sheet position, everything is so bad right now that if we were going to go into a recession right now, it could be a lot worse than a typical recession. And I think the Fed knows this. And so I think that's even more reason that if we see the economy continue to slow, it's very likely that we see the Fed cut rates. And I think that could be a recipe for this idea of stagflation, where we just see inflation go through the roof, real interest rates go negative, meaning inflation's higher than the risk-free rate, and we see a lot of bad things start to happen.
Yeah, it's interesting though, because the government, it's interesting because when inflation is high, obviously that's not good for the the government doesn't like that because it hurts elections, especially in an election year. That's never a good thing when you have runaway inflation. But you mentioned the debt, Jay. I mean, that's one of the ways governments generally deal with their high debt. They inflate it away. There's no way they're going to be paying this debt off. It's kind of, I've lost track of what number we're at now, like whatever the debt is now. But as the debt's going to kind of continue to grow at whatever pace it's growing. But if inflation starts growing at a higher rate, then actually in sort of real terms, the debt actually starts to come down. And there's been a lot of arguments over the years that that's the way governments are going to deal with this problem, which is they're going to inflate the debt away. And so the government would love to have a little bit of inflation in there, but not too much, because they get too much, then you have sort of the people rising up and having an issue with it.
So let me talk about that. And I think that's actually the bigger issue here, is that we have this middle class that's going away. Inflation is good for some people. Inflation is going to put those that have assets, those that have cash, it's going to push them up the socioeconomic spectrum. It's going to make the rich get richer.
Those who have debt, those who have debt, right? If you have debt, fixed debt, and your assets are going up, but your debt is being fixed, that's amazing.
Exactly. Now, inflation has the opposite effect on people that don't have a lot of money, the people that need their paychecks to pay their everyday bills, to be able to put food on their plate and put a roof over their head.
And I'm just going to come out and say it. This is drunk real estate. If you look at stagflation now, like obviously if there's like a huge job loss and stuff, that's not great for real estate investors. But if you look at stagflation, so what's going to happen? You're claiming they're going to lower interest rates. Good or bad for real estate investors? I would say good. Inflation, good or bad for real estate investors? I would say good.
I would say only to a point. I would say if super high inflation is actually going to be really bad, because the devaluation of the dollar is going to cause all these people that want to rent to be putting a whole lot more money into buying clothes and buying food and buying other things. They'll still be able to put a roof over their head, but they're not going to be able to. I mean, if the cost of everything is going up,
about recession, then because then that's pushing. You're saying pushing inflation, pushing us into a recession.
No, what I'm saying is it doesn't help us as real estate investors if expenses are going up at 10%, but rents are only going up at 3% because regular people can't afford to pay 10% more every year on rent.
At some point, inflation is actually like a deflationary effect on assets.
Thank you. That's what I was trying to say.
At some point, yes. But in general, inflation also inflates rents. I would say, like, yes, you could say extreme cases, but in general, inflation already inflates rents.
What's inflation right now?
2.8 right now, if you go by the PCE.
And so inflation is higher than average right now. What are rents doing over the last year?
All right, you want to pick one point in time right now? Like, let's look historically, though. Historically, rents go up with inflation going up. Would you disagree?
No, I 100% agree, but that's my point.
Jay, no, let's play this. You want to play that game? So when inflation was 9%, how much did rents go up? 14%, Jay. The answer is 14. So if you want to play that game, we could play both sides of it. So,
but we're talking about, let's say we get this thing called stagflation. I submit that the rules change, that we don't have the regular, this is what's good, this is what's bad. I would submit that everything is going to be bad for everybody in that situation.
I guess I disagree. So right now we're in commercial real estate in general. If you want to look at like residential real estate, yes, prices haven't come down, but commercial real estate prices have come down mainly because of interest rates, all the issues that come along with it. It's not just cap rates because of interest rates. It's everything goes along with interest rates. Well, if what you're saying is correct, that we get in that situation, the Fed's going to have to lower interest rates. Well, that's going to hopefully help in that issue. Inflation. Let's go based on the assumption that inflation and rents are a little bit in step. So let's say, okay, inflation goes up to 5%, rents go up 5%. If we see rents go up 5% and our expenses go up 5%, what is our NOI growth and therefore our growth on our property?
It's going to be positive because
it's going to be 5%. If our rents go up 5% and our expenses go up 5%, our NOI still grows 5%, and therefore the value of our property goes up 5%. So if inflation and rents are at 3%, our property goes up by 3%. If inflation and rents are up 5%, our property goes up 5%. Better for us. So if you want to talk about people who for stagflation, who's it hurting the most? I would argue that real estate investors are probably insulated the most against stagflation.
They're insulated until you get to the point where the renters can't afford your rent. And I don't know how close we are to that, but there's going to be a point where they cannot afford the rent. And I've talked about this a lot, and I've decided I'm going to continue to talk about this anytime I get, because I think fast forward 1, 2, 3, 5 years, I'm going to be able to put back to these videos. But historically, as rents have gone up, people have been, especially the middle class, has been unable to afford things, including rent. And so what's had to happen over the years is you'd had to have a second spouse go into the workforce in order to be able to cover what ordinarily a one worker household could do. And so that's been going on since the 50s. It's been, however many, 50, 60, 70 years. But we're getting to the point now where now the 2-income family is having a hard time keeping up with inflation and paying the rents. There is no third spouse. There is no third spouse to jump into the marketplace and into the workforce. And so what you're going to start seeing, and you're starting to see, is people having to bunk up. I mean, I'm here in Southern California, which of course is not a good, it's not the best sample study, but there are grown men and women who are having to bunk up with other grown men and women. And instead of having 3 different apartments to go rent, and you have 3 new tenants, you have one rental that has 3 people in it because they can't afford to pay rent by themselves. They're literally renting out rooms because they can't afford to pay the rent. And I just think that's going to be something that's going to continue to be more and more exacerbated. So there's
I don't know exactly where you're talking about, but your occupancy in that area, I guarantee, is still over 90%. Like countrywide, our occupancy is still pretty good as far as multifamily, even though people are having affordability issues.
Yeah, but I guess it's the idea that you can just raise rents 5% for the next 10 years, and suddenly, fast forward.
Where are they going to go? Where are they going to live?
So, Kyle, let me ask you a question. When we screen tenants in our multifamily units, what do we look for? What do we require them to have in terms of income to rent ratio?
Well, depending on the property, but I see what you're saying, 30%.
30%. So basically a typical renter can afford to spend up to 33% of their income on rent. And basically, if they have to spend any more than that, they don't qualify for our property.
Okay, what about the A-class people? What about the A-class people that don't qualify for their A-class anymore because the A-class rents at $2,000, so they don't qualify for that, and so then they go looking for a property. Where are they going to go? They're going to go down to B-class.
And they'll move down, and there'll be some A people that move down to B and C, and they'll be fine. But there are going to be a lot of B and C class renters that they can afford to pay up to 33%. Well, right now, as of a few months ago, the average renter was spending 30% of their income on rent. So they've got a little bit more that they can spend. But if inflation, if the cost of everything is going up higher than wages, well, at some point that 30% that they're spending today is going to hit that 33% number, and suddenly nobody's going to qualify for our properties anymore unless we hold rent steady.
We can only build A-class properties in general. I mean, we have, like low-income housing tax credits and things like that to help out lower class. But in general, we can only build new properties and A-class properties. There is a housing shortage in the lower middle class properties, and that's not going to go away. So even if you have affordability issues, then people are going to have to move down. You're going to have issues, obviously, with the C class, the people who are, you're going to have delinquencies in rents. You're going to have evictions. You're going to have more of that. And you're going to have problems with the A class. But I would argue that the tried and true, don't go for the super high expensive ones and don't go for the shittiest ones. If you stay kind of somewhere in the middle, then you're relatively insulated against a situation like that. That's my argument. It might just be, a bad theory, and I might get proven wrong, but
let me throw something else out there that I think, talking about how this impacts us as real estate investors. So if the government needs to start printing a lot more money, or even if they just keep printing the same amount that they've been printing, but let's say they have to print a lot more because they need to do more stimulus, and they need to release more currency into the system. Basically, they're going to have to issue a whole lot more treasury bonds. And the Fed can control treasury yields, treasury rates at the low end of the curve, the 1-year bonds, the 6-month bonds, the 4-week bonds. They can't control yields at the long end of the curve. They can't control the 10 and 20 and 30-year yields. And so if they start issuing a whole lot of bonds, what's going to happen? Eventually, we're going to run out of people to buy those bonds, and we're going to see the long end of the curve, those 10, 20, 30-year bonds, we're going to see yields go through the roof. And what happens when 10-year yields go up?
We had this discussion last week, though. If this is going on in the U.S., if we're having this issue in the U.S., what do you think's happening on other places in the world?
The rest of the world's screwed.
Exactly.
I'm not arguing that.
So, if you're a foreign investor and you're looking to put your money somewhere, all of a sudden our 10-year bond is looking pretty good instead of the Japanese yen. So, like, I'm not concerned about demand. If we ever get in a situation where we have to print too much, that's usually means that the rest of the world is just as fucked as we are, even if not more. And the people are going to come in and they're going to scoop those up like hotcakes. If anything, it's going to bring them down.
But we've already started to see a slowing in demand for those 10-year and 20-year bonds.
Jay, I wanted to bring up, you brought something up about the having to put more currency units into the system, and I was checking out this. I'm sure you've seen it as well, but this M1 money supply curve, like how much money's actually getting into the system. M1, this thing peaked in 2022, but since the peak of 2022, which is coincidental with all the sort of the beginning of the downturn on especially multifamily, that's kind of when in our world, I think it pretty much peaked in that second quarter of 2022. Since then, you've actually seen a drawdown of M1 money supply, and I'm just wondering how if you thought of that, or you've looked through this, but that seems like money's getting sucked out of the system versus money that's been added to the system over the last.
Yeah, we had a long conversation about this 2 weeks ago when you weren't here, and luckily we had a replacement for you, Anna Kelly, who's a whole lot smarter than you were. And yeah, we talked about the fact we were talking about the M2, but yeah, it's the first time since the 1940s that the M2 money supply has contracted. It's been like 1.4 trillion over the last year and a half. And so, is that good? It is good. But it does incur more risk because it's essentially quantitative tightening. It's the same as
that's my point. Like, how do you jibe that with inflation? Maybe Anna did talk about that, but like, how do you jibe that with inflation? Like, you're getting this core PCE is pretty high. The PCE is higher, not high, but higher. How is that happening? Why are we going in the wrong direction when money's actually getting sucked out of the system?
Yeah, that's the problem I'm talking about. We are no longer effectively, or when I say we, the Fed is no longer effectively controlling inflation. It seems to be out of their control. And I think the last time that this happened, where the Fed just couldn't control inflation and was always behind the eight ball, was back in the 1970s and 80s. And what did they do? They had to chase it up, and interest rates got to 18, 19, 20%. And so, and here's the other problem. I mean, we solved this problem in the early 80s. A lot of people say that Volcker was the guy that came in, the Fed chief in the early 80s, and said, okay, I'm willing to raise rates as high as they need to go, 17, 18, 19%, to finally quash inflation. It's that important. Who among us thinks that Jay Powell is willing to do something like that? He certainly hasn't indicated that he is. He's going to go the other direction. So right. I'm
going to steal the mic from Jay because he just wants to talk here, and AJ's just sitting here quietly wanting to go. So, AJ, do you have thoughts? And like, would a recession cure this? I guess is the thing. Is that the only cure we see right now, or is there something else that could happen?
This evolves around the soft landing talk that we had a few times ago. One of the most interesting things, though, I think about all of this isn't necessarily the interest rates and inflation. It's the balance sheet. The Fed's balance sheet reduction. We've never seen ever a federal government reduce their balance sheet without consequences. It's never happened. So if they successfully reduce their balance sheet without having major effects on markets, and they do that in lieu of being too dramatic with interest rates or cut that back, I think that's the play here. And I think they're trying to unload the balance sheet. They can't do both things. I think they can't be hyper aggressive on interest rates, really squash it, reduce the balance sheet at the same time, and not expect the wheels to go completely off. I think that a recession is trying to avoid it completely. I don't know how effective that is because you can't. And so I almost view what they're doing as they're just prolonging something, and they're maybe making it actually worse. this happened with lots of other things. You see when the government comes in and they don't let the market do the reduction that it needs to do. We need to wipe out debt. We need to have people lose their jobs. We need to reduce demand. The jobs aren't, even though employment, we've talked about employment, but most of the employment is from people working 2 jobs now. You've seen an actual reduction in salaried employees, right, and full-time. So the employment situation, I don't think is nearly as good as previously stated, but lots of people still have jobs and people are still spending. It doesn't, whether it's worse than they state or not, doesn't take out aggregate demand. It's not there. And so the question is what is even normal? Is this employment rate normal? Is this, the debt levels that we have normal? We have not had, the economy hasn't had a chance to correct after we pumped $4 trillion into it. It's being artificially hanging on. I think that, a recession is what's needed. And I think that it's a normal thing. I think that trying to avoid it too much, right, is problematic, in fact. And so I think that we have a lot of fear going into an election year on what should be done and what shouldn't be done. We are really hunkering down here on trying to keep the status quo, interest rates not crazy, but too high than they should be, and a slow burn off without breaking everything down to gain a soft landing. The gains in the economy, though, with I think a lot of AI with what's going on, has been outpacing. So the economy has functions of it in the technology sector and other things that are driving wealth, that are actually still moving things. And it's outpacing the effects of interest rates right now. It just is. That there's so much money and things are going on. So I think that a recession is probably necessary. It's not something, obviously I don't want it. Nobody wants a recession, but that's like saying I don't want night to come because I like the sun. Okay.
So Jay, would that solve it? I guess is like, the fear of stagflation. If we just allowed a recession to happen, wouldn't that kind of take care of it?
So, I mean, most recessions are disinflationary, meaning when the economy starts to go down, inflation goes down. And I'm hopeful that if we see the recession that looks like is coming, and honestly, I know my tone has changed over the last couple months because 3 months ago we did an episode, 2 months ago we did an episode where I was touting the soft landing, and it looks like we've achieved it. But we're starting to see some data that indicates that may not be the case. And so, the question is, when we have this recession, is it going to be disinflationary? Are we going to see inflation go down? Or is this going to be one of those rare cases where the recession is actually inflationary? And here's the reason why I think it might be inflationary. The rules have changed. So it used to be that the government let us go into recession, and they would take measures to kind of mitigate and make sure didn't get too bad. They would lower interest rates. But what we've seen over the last couple of years is that they're willing to take extreme measures. They're willing to lower interest rates very, very quickly. And then look back to 2020, 2021. We did something that in retrospect was absolutely the right thing to do. We helicoptered money, $4 trillion to pretty much every American. And I have no problem with it. Again, I think it was the right thing to do because I think COVID, AJ is saying no, but I think it was the right thing to do. But the crazy thing is, this is by the definition that most Americans have of the word socialism. This was probably the most socialist thing that this country has ever done, literally taking trillions of dollars and just mailing checks to every American. And it was done by the party that rails against socialism, the party that is all for fiscal conservatism. And if that party is willing to do it, we all know the other party is willing to do it 10 times worse.
You gonna let that slide, AJ?
They did. No, it was totally horrible. It was fear gripped them, and people got completely unreasonable and lost their minds, and the government just $4 trillion.
I think both parties kind of contributed, though. First party.
No.
Second.
What I'm saying is the Republicans did it, and they rail against it.
Should have been the check. They should have said no. They should have stopped.
Right. If they're willing to do it, I can't even imagine if the Democrats are in power the next time what they're going to be willing to do. They'll do 10 times worse.
I completely agree. I think it was terrifying to see what they are willing to do to try to stave off bad things to do. It was shocking. It was literally shocking. The amount that they pumped in was so astronomical because they didn't even want things to not crash. They made them go up and they kept pumping money in. They wanted the economy to keep cooking. And then too, when all the data came out, even when they made changes, they saved off. They stopped. They would not change course.
But has all that money worked its way through now though? Has it been long enough? Like it's definitely dropped off of the average American's balance sheet. Like they've worked their way through it.
The government is still putting $1 trillion out every 100 days. So at this point right now, the government is pumping more money into the system currently than it has in any recessionary period. And we're not in a recession. So right now, our spending is higher currently than it was in 2008. And during the great financial crisis, the government's spending. So not only has it not gone out, the government's never given a chance for the money supply to reduce. They're pumping it in like there's no tomorrow.
The value of the total equities market, the stock market, to GDP is something like 190%, which is, I mean, it got over, I think, 200 or 210% during COVID. But barring that short period of time, this is the highest it's ever been. I mean, real estate is 30 to 40% higher than it should be given the long-term trend. And my argument a couple months ago, because I don't want it to sound like I'm reversing. Well, I am reversing course, but I want to explain why I am. My argument a month or two ago was that I thought that the economy was going to stay strong enough that inflation was going to catch up, assets were going to level off, and inflation was going to allow wage growth to catch up to the value of assets.
So, but is all this just because, like, basically we're basing this off of 1 quarter GDP print and a couple months of inflation that was higher than it's supposed to? Because if you look at Fed's measure of inflation, there's all these other numbers, you know, core versus PCE versus CPI versus headline versus all these things. But if you look at what they look at core PCE, and core PCE, the last 3 months were 2.9, 2.8, 2.8. And I know they've said their target is 2%, which is the biggest mistake they've ever made. Like, I don't even know like where this 2% came, that all of a sudden that was the target that they decided. It was kind of an arbitrary number that they just came up with years ago, and they're kicking themselves now.
I heard an interesting theory on that, by the way. We'll come back to it.
Yeah, I heard that it was based off of some random country pegged that as their what their target was, and that's where they got it from. But if you look historically, like 2% hasn't been like the standard. Like, we've always been above 2%. Like, being in the twos has kind of just been par for the course previously. So if we're at 2.8, like, other than the fact that they've said 2% is the problem, like, we're in the twos. We are, yes, we had a couple months, but in general, the direction still has been down. You can't say it's really going up if you look at core PCE. And we've had 1 GDP quarter of lower than expected. So, like, is this what all this panic is coming from?
Yeah, but why are you looking at the, like, I'm going to go back to my initial issue with the core PC to begin with. And I understand it's the Fed's preferred, you know, measure and all that stuff. But at the end of the day, it's a statistic that takes out food and energy. It's like, I'm like, obviously we need food and energy. So if you're looking at the reality of, again, looking at everyday Americans who have to go buy, Kyle, they have to go buy eggs at the store, those eggs are more expensive. Your rent's more expensive. Everything is more expensive. And yeah, this core PCE may be, it's not as bad, but the real inflation, whatever that is, and everybody has their own little inflation basket. Everybody buys different things. Everybody's inflation basket is going up way more than 2.8%.
Well, and prices haven't come down. We're like, even though inflation may not be 5-6%, it doesn't matter. It went up so much. We did not have an offset of income growth. So the pressure of that inflation is still there.
Yeah, inflation is not coming down. It's just the rate of increase is coming down, but it's still going up by 3, 4, 5, 6%, whatever the number is.
Here's why I'm more scared now than I have been. A couple things. One, if you looked at the estimates for GDP in Q1, the estimates ranged from 1.7% to 2.8%. We came in lower than the lowest part of the estimate range. So nobody expected this. That was number one. Number two, when output drops, when productivity drops, when GDP drops, what do you expect to happen? You expect that inflation should drop. And so what we saw was 3 months. We didn't get that GDP reading until last week, but that GDP reading measures January, February, March. In all 3 of those months, we saw a high inflation read. And so given the fact that we've seen slowing output for the last 3 months, but we've seen increased inflation for those last 3 months, that's telling me that there's now some disconnect between output, economic output, and inflation. And that disconnect is bad. And so the question is, has the system broken? And could we see output go to 1% or 0.5% or negative? Could we see negative GDP and still have inflation? And that's scary. I don't know what the answer is, but that possibility.
But previously, though, Jay, like you've brushed off like GDP prints as, oh, it's just a single quarter. There were some quirks in this and like whatever. But then all of a sudden we have one quarter now and everyone's losing their minds. Like, is like what has changed all of a sudden that, like, other than it's just a compound effect that we had the inflation come in above expectations and the GDP come in lower than expectations. But at the end of the day, like, let's look at the data over the course of the last 2 years. And should we really be panicking?
And no, for the last 18 or 24 months, everything's been great. This is the first time that we've seen that disconnect. It's always been, like I said at the beginning of this episode, like when it comes to both the economy and inflation, normally you have one good and one bad. The economy's good and inflation's bad, or the economy's bad and inflation's good. And right now, both are bad. And that's scary. And by the way, let me go back to this real quick before we move on. I don't know if this is true, but I heard a
but
guy.
You're gonna say it anyway.
I'm going to say it anyway because I thought it was an interesting theory, and I haven't fact checked it though. I can't remember who said it, but I was listening to somebody who was a large fund manager. You guys can go fact check it. I don't care, or you can ignore it.
I don't know if this is true or not. I don't know who said it. Oh, some dude. I don't know. My mom, my grandma. All right, go ahead.
Let me know when you're done. I think you'll like this, Mauricio. So this goes back to that 2% Fed target. What he said, and again, I haven't fact checked it, but what he said was exactly what you said, Kyle. For decades, we saw inflation at 2.2, 2.5, 2.7%. Fed never said a word. They never set a target. Everybody was happy. The one time, or the time that the Fed actually like comes out and says, here is our inflation target, was after a couple years of lower than 2% inflation.
Because they wanted to print money.
They didn't want to print. They might have wanted to print money, but basically what they wanted to do is they wanted to ensure the rich were doing well. And so how do you do that? You need higher inflation. And so they set that target when inflation was below the target, which is, I guess, different than everybody assumes. Everybody assumes that they set that target when it was higher and needed it to come down. They actually needed it to come up.
Well, it's just not the rich, though. To say that inflation only helps the rich is not true. If you don't have inflation, you don't have growth, and nobody does good. Inflation, I think some people think that like inflation is bad, or that the government's doing it just to reduce debt, or that it helps out the rich. What we're saying is growth. Growth reduces liabilities that you have today. If I grow, right, financially, my liabilities, yes, are less. If the products, services that we do grow, they're worth more. We pay people more. Inflation is the reason why people get paid more, right? So I think that we got to be really careful too, saying that Main Street is not benefited by inflation, because that's not true, right? It all works together is what I'm saying. It's when they get out of whack. And I think that's what Jay's saying too. It's out of whack. So we have this weird disconnect that's occurred, and where we thought you could roll lower interest rates to affect the economy to grow it, which that's a good thing, because if we go into a recession, that's what you need to do. The fear is now that we can't do that. So all of a sudden, if we get into a recession and we can't lower interest rates because immediately we get an adverse effect on inflation and everything else, what tools do we have at our disposal to really affect Main Street? Right. And that's employment and everything else. If you have high employment, if you get the stagflation, high unemployment, and you have inflation, and the government can't spur business, it gets into a messy situation. If you just have a recession, we have a contraction in the economy, debt gets wiped out, people get laid off, the government comes in, injects money, people invest, their money starts to get lower, it starts to go, right? Inflation pops up, all right, shoot interest rates up and drive it. Those are direct correlations that the government can do. This sticky spot we're in is what's scary. It's the divesting of those two functionalities that are supposed to be there to offset when you can't utilize them because they are no longer connected. That's when it gets scary.
Yeah, but AJ, you're also, I mean, let's just make sure we're on the same page. I mean, there's a difference between, and we're differing on the definition of inflation. I don't want to get into that, but like there's a difference when something's growing when there's growth in the economy, that's obviously a good thing. If prices are going up because there's growth, that's one thing. That's all good. But if prices are going up because it's artificially being, added, the currency units have been adding by money printing or feds or the government, that's just diminishing everybody's purchasing power. There's no actual growth going on there. What you're looking for is growth, not necessarily prices going up, because prices going up is just your purchasing power going down if that's all that's happening.
100%. I completely agree with that.
Yeah. The interesting thing for me is what's the timeline going to look like? And I think this is what I've been thinking a lot about, because I suspect that these days politics takes precedent over people, unfortunately. And again, both sides. I suspect that if we start to see a recession, if we start to see the economy getting hit over the next few months, the Republicans who are not in power will look at this as an opportunity and again, Democrats would do the exact same thing. They tried to do it back in 2020. So again, this is not it is partisan, it's both sides. But I suspect that the two sides will not come together on how to fix any issues that happen between now and the election. And so it could be really interesting to see if things do go downhill and it requires some money to be printed or some extraordinary measures from Congress to be taken. If the two sides can come together, I suspect they won't, and I suspect both sides will do their best to use whatever happens as an opportunity to help their chances in the next election. But I suspect after the next election, all bets are off, and both sides are going to be willing to pull out all stops to ensure that the economy stays strong, or their definition of strong. And I'm concerned that what they will do is they'll do the thing that seems like it should work, which is lower interest rates, print a lot of money. But I think it runs the risk of this super high inflation, stagflation situation. So if I were to predict right now, I think I'm more concerned about first quarter of next year than I am about the next few months. And I'm not saying we won't see recession in the next few months, but I think it could get a whole lot worse a year from now. And which sucks, because I think a lot of us thought a year from now things should be getting better.
I guess it depends on what you're meaning of getting better, because for real estate investors, low interest rates and high occupancy, technically better for us. So
maybe very short term.
You know what? It would make underwriting a lot easier, though, if we could see a little bit of stability and something like that.
Paul, do you know anybody who can give us a master class on that?
I mean, there's a lot of uncertainty these days in the real estate space, and that makes projections and underwriting just very, very difficult. And I was looking for someone to help. I didn't know where to turn. And finally, I mustered up the courage to go and approach this amazing investor, AJ Osborne, and asked him to help me out with some tips on how I should be underwriting in today's high interest rate, markets, with banks not lending, everything going on. And he suggested, why would he just tell me his secrets in private when he could come on our podcast and tell the world? So AJ, why don't you help us out and tell us how people should be going about underwriting in this market right now?
This was really hard for Kyle to humble himself to get to this point. So we're all very proud. So as far as underwriters go in the room here, I think that's being
well. And of the four of us on this podcast right now, only one of us have done a recent webinar on how to underwrite properties. and it wasn't me. And actually, I don't think it was you either, AJ.
I don't think so either.
And Mauricio was a lawyer, so.
Hey, I hosted an event about how to underwrite multifamily. It was a great episode.
This has been the week of underwriting.
That's right. It's a great week, really boring week. So underwriting, I think, yeah, all kidding aside, it can be really tough right now. Really hard for people because past trends may not be moving forward. So when you're looking at pro formas, when you're looking at things that are changing quickly, interest rates, debt overall, period, and how that's going to work within the property. When we're dealing with underwrite, at the end of the day, let's keep things fairly simple to start out here with underwriting. All we're simply looking is you're trying to look at a property if you're buying it. What is the value of that property today, and what will it be in the future at any given time, right? And then what are you willing to pay for that value? That's it. That's all we're doing. Is it worth it to you? Is it not? Can you get it for that property? Right now, the underlying value in commercial real estate, we use cap rates to talk about value. Okay. Cap rates do not include debt into that equation. Now, investors do include debt into the equation. So when you look at the price of assets on the market that are trading, right, what the investors want and what they're willing to purchase those assets for, that becomes a sales price. Now, that sales price is the price of the asset, but what the asset makes, how it performs, what it does, that's really what we're underwriting for. The price is just something negotiated between buyers and sellers, right? But underwriting, we're looking inside the property and we're trying to find out all sorts of stuff. We're trying to see what is left on the table, what money's left on the table, what we can get out of it, what we have to do, how much it's making, what are the risks, what are the dangers. And as you can get bigger properties and more things going on, right? It can get, I think, generally speaking, more complex as you add all sorts of things onto it. That may be different structures, waterfalls, syndications, on and on and on. But the complexity is all coming from really the most basic thing, which is net income. So no matter how you look at it, we're trying to understand how stable it is. I always think there's only two ways to change value: revenue, right? Or net income, meaning revenue, that's all you got. And then overall, the securitization of it. So how safe is it? If you have a property that makes $100,000 and that property is guaranteed to make $100,000 every single year for 10 years, that value goes up, meaning that there's no way it can lose money. Also, it goes up if you say, listen, every year it's going to make more money. So when we're looking at that, how much does it make? What's it going to make? And how safe is that revenue? We're trying to figure that out in underwriting. Why that is more complex today is we have all sorts of things going on. We just went through a decade where occupancy and rents went up. So when we're looking at how safe is that net income that we're buying, that is a question to a lot of people. And that gives on certain markets and certain areas. They're not all the same. Then when we look at how that'll play out in the future over the next 4 or 5 years, you have a lot more people that are questioning that now. And they're trying to figure out how we underwrite in these market conditions where things are changing. Now, a lot of people will underwrite different asset classes, obviously have different things that you're underwriting for and how you do it. I don't do multifamily. That is these guys. They have all these different tricks and little things that they're looking at. I don't want to dive too far down into obviously the details of underwriting and finding, oh, well, you can put a power unit necessarily here. That when we're talking about global underwriting, the inputs that are affecting it for me, obviously we'll let you guys hear, we're really trying to understand overall demand in these areas. I don't care if that's multifamily. I don't care if that's storage, industrial, whatnot, whatever's backing the revenue and telling us whether the revenue will go up will be the demand of the customers in that area. And that has become one of the most important things right now because demand is one of the things that's in the most question for us. So demand is driven it for us on two spots. You have overall market, we'll just say market data, demographics, things like that, organic, right? But then we also have the asset itself. So you can have a lot of demand and too many people can build and supply outweighs demand. And then you have occupancies drop and rents drop. right? You can actually not have a lot of demand. Like there's not a lot of people moving there. There's not a high birth rates, but there's none of that product. So demand is really high for it. So demand you can have, and given one of those two components, right? And one of those two components can actually make demand go away. And that's what we're trying to understand and look for in underwriting that will push then the numbers and everything moving forward. And it's going to be worth more. Everybody wants to know, is this a good deal? Is this going to do better in 3, 4, 5 years? Should I be buying this? How safe is this? Will it make more money? Right? All of those things really come down to demand, how much it'll outpace, how much it'll do. The other side outside that is the operational component. We are operators. So when we look at underwriting, we're underwriting it through our operations. If you're hiring a third-party management company, you would obviously have to take into account their expenses, how they're going to operate the property, and what that will look like as far as an execution goes. Capital expenditures, right? All of these kind of things. So once again, trying to keep a very complex subject, a little more core here. That net income, how resilient is it? Is this net income, what it is, going to keep coming in? Is it going to grow? Is it going to go down? How much is it? And what should I pay for it? Really, this is the basics of underwriting. And when we look at that, trying to understand that as far as that net income goes, one of the things that people get confused about is buyers buy for different reasons. They have different strategies, and how they can pro forma things are different. You may have different expense loads. You may have different opportunities that the other person doesn't. So all of a sudden, one deal may not be a deal. My deal may not be a deal for you, right? Your deal may not be a deal for me. That doesn't mean it's not a good deal, though. And the reason is because of what you want out of it and what you're trying to get out of it. And so these are a lot of the things when we get to underwriting. Things, though they can be complicated, we try to identify a buy box in very simple terms. So I have a buy box on the asset type, the market, my returns that I'm trying to get from it. Then I can decide what are good properties for me. And then underwriting follows those things. But one set, what you're trying to achieve out of it and what you're trying to get, that's all played out in underwriting. It tells us everything we want to know about, how we're going to execute, what it's going to look like. This is why real estate investors spend tons and tons of times, like Kyle does, in spreadsheets.
But AJ, but given our conversation we just had about stagflation and things kind of maybe potentially going in the opposite direction, how does that affect all of that? I mean, that's got to have some impact. And I guess the question that a lot of us are having is how should we adjust that going forward based on what we've been talking about today?
So the two components, once again, my net income, how will those things affect my net income? When we're looking at demand, that's why demand is so important. So, whatever it was 3 years ago, I got really worried about the storage industry because I said demand's going to fall because of rising interest rates. So the rising interest rates, the reason we thought was going to impact demand and storage was because of how it would impact housing. In housing, and the movement of housing is the revenue driver that affects demand and storage. So, right, so we understand what drives demand here. Then we look at how the things that drive demand are going to be affected. In a localized market, that's new supply. If I'm buying a multifamily project here and they're building thousands of units all around me, is that going to affect my demand of my core assets? Same with storage, same with anything. On a national level, though, if housing costs, drop to be super cheap and interest rates drop, are people going to stop renting and are they going to start becoming homeowners? And if they're not, if they can't have access to homes, are we going to have more renters? Are incomes going up or down so people can pay more? Well, if I'm in a market and I'm buying an asset and income's dropping, people are moving out of that market, what is driving demand to get further higher returns moving forward? And so when we look at the macro part, when we're looking at all these things, it's the effect of that demand in local markets and what we care about. Commercial is localized. That does not mean it is not affected by macro events. This is obviously a really important thing to do, but it may be a different way of looking at it, right? So when we're looking at stagflation, inflation, if you say, my thesis is inflation is here to stay. High interest rates are here to stay, at least for the foreseeable future. Okay, well, then you're looking at, multifamily in whatever market. What does that mean to that local market? What has happened up to it? And you're in a great spot to be in. If this was a year and a half ago, there would be way more questions. So a year and a half ago, you may go, I don't know what's going to happen with high interest rates. That's way scarier. We can actually see today what markets have done well, what have suffered, how incomes have done right in a high interest rate environment. That makes underwriting today way easier. So us underwriting like storage deals today, we went through a down season and an up season with high interest rates. We now have way more confidence in our underwriting. I can tell you which markets got hit really hard and are going to have struggle coming back, and which markets didn't and still have core demand. So right now we're at a spot where it's more known the effects of high interest rates in the short term and how we can see it affect. But once again, it's how it affects that net income.
And just stepping back a little bit, I mean, the whole purpose of underwriting is to assess risk. That's what we're trying to do. We're trying to assess risk, and the process of underwriting is really, it's twofold. There's a science piece and there's an art piece. And the science piece is basically you enter a bunch of numbers on a spreadsheet, and then you make a bunch of changes and pull a bunch of levers and push a bunch of buttons to try and get the numbers to work. That's the science piece. The hard part is the art piece, and that's figuring out what numbers to put in. And figuring out what numbers to put in is really all about making assumptions. And that's what AJ is talking about, making assumptions. What's going to happen in the future? And underwriting as an art isn't so much about really being good at underwriting. It's about having a crystal ball and figuring out what the future holds. Because when you're underwriting, you have to figure out things like, what's your income going to look like in 2 years or 3 years or 5 years? And a lot of times it's not obvious. If I'm doing renovations, my income might go up, might go down, like in the first year, might go up or down in the second year. Eventually it's gonna level out. We have to figure out where it's gonna level out. What's occupancy gonna do? Because ultimately that impacts revenue. That impacts our rents. And so we have to guess, is occupancy going to go up? Is occupancy going to go down? On the expense side, we have to guess, are expenses going to go up? If they're going to go up, are they going to go up at 2% or 3%, or is inflation going to be high and they're going to go up at 6%? And then things like insurance, which may not go up at the rate of inflation, that could be completely separate, and property taxes. And then we have this thing called a cap rate, which is like the multiplier that we use. So we know what the cap rate is when we're buying it, but the important question is, what's it going to be when we sell? And so we have to have a crystal ball to try and figure that out. Our loans and our loan terms. So interest rates all play into the fact that, we know what the loan terms are today, but if we have to do a refinance, or if we have to get a new rate cap or whatever it is a couple of years down the road, we have to guess what the economy is going to look like, and interest rates are going to look like, and mortgage rates are going to look like, and all that sort of stuff. So being good at underwriting is really about forecasting what's going to happen in the future and putting that into your assumptions, putting that into numbers in your underwriting. And that's really, really tough. And it was a lot easier back in 2015, 16, 17, because in retrospect, at least, we got 5 years of things went exactly as expected. But these days, I don't think anybody thinks that they know or that they can predict where the economy is going to be in 2 years or 3 years or 5 years. And so at the end of the day, we just need to be really conservative. We need to make our best guesses. And then most importantly, we need to do these things called sensitivity analysis, where we say, if our assumptions are wrong, we assume to the good side or the bad side incorrectly, how does that impact us? And I think that's the most important thing we need to be doing today, is really looking at those sensitivity analyses to see, if we're wrong in our assumptions, how does it impact the deal? How wrong can we be before a deal loses money? Or how wrong can we be before a deal loses all our money? And those are the big questions we need to be answering for investors these days, because as an investor myself in other people's deals, that's the first question I ask. I want to see the sensitivity analysis. If you're wrong about the income growth, if you're wrong about the cap rate, if you're wrong about your insurance growth, well, how wrong can you be before I'm screwed and I lose all my money?
Is it a little bit easier though, Jay? Now, this is just throwing, somebody who has no clue about underwriting. This is kind of one of my questions. Is it a little easier today than it was, I don't know, a year ago when, we had interest rates going up every quarter? You had really no clue. When we were at 2%, 3%, 4%, you didn't know if we were going to go to 5 to 6. Like, you didn't know where we were going to land, versus today, most people feel like we're already at that upper, now there's some rumors that we might start to go up even a little bit higher based on what we're seeing now. But we're at, what are we at, 5.25? I mean, you're not going to go to 8, in the next year. Is that made underwriting a little bit easier, or do you still think, hey, I wouldn't make that assumption. Maybe we do go to 8 or 9 in the next, that's still on the table.
I think it was easier a year or two ago because everybody said we're only going to do fixed rate debt. We're not even going to consider other types of debt because we can't make assumptions around other types of debt. So we locked ourselves into taking some assumptions off the table.
You guys want me to put my 2 cents in? I don't know. I know I'm not qualified amongst you, Jay or AJ.
So for the listeners, Kyle is the lead underwriter for Bar Down Investments. So I'm not sure he knows what he's talking about, but we do trust him to do it.
So Jay's correct. Your timing's just off. A year or two ago. So the reason everyone got in problems a year or two ago is everyone was doing the opposite. They were doing bridge loans.
That was 4 years ago.
So it was easy. 2019, like right before COVID, super easy. I was underwriting the exact same loan for every single property. Every property was over 90% occupied. I could get a Freddie Mac floater for 10 years and at a great rate. And, it gave me exits on the back end. No one had ever seen any issues with floating rates in the last decade. Everything was good. It was easy. The problem is that COVID happens, and then all of a sudden a lot of money floats into the market and it gets very competitive. The properties get very competitive. So people start searching for ways to get more competitive. And so what people did is they figured out that, hey, what's our biggest hurdle in order to paying more money for a property? And that's our cost of capital. Our cost of capital for the average syndicator it's our biggest expense for, other than, like if you're talking about property taxes, insurance, but still at the end of the day, we're paying the most to our investors. And it's cheaper to get loans, even if they're bridge loans. Even if, we're paying our investors mid-teens, a bridge loan is, at that time, it was only 6-7%. So what are we going to do? Oh, we're going to get more cheap debt. And so a bridge loan does that. Even though we were getting 70% LTV, sometimes 75% LTV with a Fannie and Freddie loan, you could get 80 loan to cost, sometimes, which would get you up to like 90% of the purchase price from these bridge loans. So people were doing that. And these bridge loans are the Wild West. You could do anything. You could do a 3+1+1. You could do a fixed. You could do floating based off of, at the time it was LIBOR. There wasn't really SOFR. You could basically get very creative on how to reduce your capital expenditures, like how much you had to go for investors. And now we're seeing the downsides of this. All of a sudden, floating rates aren't always the best, and having a huge capital stack on the debt side is not always the best. And so the problem is now, actually just today, I was looking at a prospectus for somebody, and they had, in 2 years, they were refining into a long-term debt, and they had a rate at 5.5. And for reference, for anybody who doesn't pay attention, this is multifamily, we're maybe like 6.5 right now. If you get a good one, you can get closer to 6.25, but 6.5 is a pretty good benchmark for what a fixed rate is. And I didn't know how to respond to that. I don't know if I'm saying that's conservative. I don't know if I'm saying that's aggressive. I can't get mad at them and criticize them for saying 5.5 is. And I will say that because I don't think even the market can decide what's going at it. And I'm going to share my screen here this is going to show you, this is the projections, and this is on the Chatham website. You can also go on to Pensford. This is the projections. The light blue is the 10-year treasury, what the projection is going forward. And the dark blue is the 1-month term SOFR. These are the two major benchmarks when we're talking about underwriting. If you're talking about long-term debt, you use the 10-year. If you're talking about short-term debt, bridge loans, things like that, you're using 1-month SOFR. This tells us that the projection is that the 10-year treasury is going to go up over the next 10 years from where we are. but it's also telling us that the term SOFR is going to go down. To me, that doesn't make a lot of sense. I know if you work out the math, it works. It kind of works out. But if I'm projecting forward, technically, if I'm looking at the 10-year treasury, then I would look at that person who's saying, hey, 5.5, that's, you guys are way too aggressive on that. We're having the 10-year treasury go up over the next 10 years. But if you're underwriting a bridge loan, you're saying, hey, that's going down. And so there's just this conflict of what rates are going to be and what we're going to have to pay in the future. Are spreads going to go up? Are spreads going to go down? Historically, you would take, oh yeah, this 10-year treasury, and you would add, 5 or 1.75, so 175 bips above the 10-year treasury. And that's kind of what your rate was. Well, right now, as you could tell, like that might be the case now, but 6 months ago, that wasn't the case. It went all the way up to like 2.5 or 20 or 250. So we have to know where these are going to be in order to underwrite correctly, because they are affecting our cap rates, which is another thing. They are affecting our valuations. And so how can I underwrite, and how can I pick, and how can I criticize other people who are picking these underwriting terms when we don't even know what benchmarks to use?
So you're saying it's harder. So basically, what I'm hearing, you're saying it's harder now than it was before, because
in my opinion, it's almost harder than it's ever been. Deals are always going to get done as long as we know what the rules are. Even if the rules are shitty, even if the way we're playing the game and what we have to work with is shitty, we still know the rules. Right now, we don't really know the rules. We don't know if banks have an appetite to lend or if they don't have an appetite to lend, because that changes every month. Based off of what Powell says, all of a sudden banks are willing to lend, and what the next month, then they're not. All of a sudden, they're scared off. We don't know what the rules are to play right now. And to your point about projections forward, like, you can kind of pay for those projections, to be honest. But if you look at like share projections, this is just a property we looked at, and like, you can go on to Yardi and you can look at, and they will literally give you what their projections and rents are and occupancy. So if you want to be lazy, you can kind of just, like, Yardi is a high priced software that a lot of money is spent on figuring out these projections. So if you aren't spending more money than Yardi or have your own shop, like, you can look at this and say, okay, 2024, yes, rent isn't growing much, but then they're projecting 2025, it's going up and up, and then it's kind of plateauing, and then the average over the 10 years is going to be this. And you can kind of use these high paid services to kind of get you out of that. But do you trust that, I guess? And like, am I really going to plug in 4.6%? Like, is that conservative? And so I've found, if you look at CoStar, who's probably CoStar and Yardi are the two biggest rivals, it's completely different numbers. So who do you trust?
Yeah, Kyle, I guess I'm a little surprised that, and maybe you tell me if this is what the market's doing, or maybe what you guys are doing, or what you guys are seeing, but I'm a little bit surprised to see that folks are even considering sort of the debt market, the bridge market again. Obviously their interest rates are lower, but traditionally we haven't been using, multifamily was not using the bridge, unless it was a true bridge, like literally there was a specific circumstance that you needed the 18-month bridge.
Right. Well, that's where the definition of the definition of the loan came from, right?
Yeah, it's supposed to be a thing, because the issue we had with COVID is that the prices, from what I saw, the prices were going up faster than NOI was going up. And so you couldn't, as a syndicator, as my clients, they couldn't get enough leverage on the properties because the debt service coverage ratio wasn't there. Like, you just couldn't, if the bank lent you 80% of the money, you just wouldn't have enough cash flow to pay the mortgage. So you had to go on a traditional loan, you had to go more in the 60-65% range, which of course syndicators don't like. And so the nice thing about the bridge was that, hey, I can push the leverage up to more like 80%, or to your point, sometimes 90%. But that was because everybody just assumed, hey, look, real estate is just going to keep going up and everything's going to be dandy and I'm going to be able to refinance in 2 or 3 or 4 years. I don't see that the case right now. I mean, for somebody to come in and say, hey, I'm going to take a bridge loan right now and refinance, like to your point, in 2 years. I mean, that kind of, I know, is that what you're seeing though? Or are people looking? That kind of mortifies me, to be honest with you. If that's
no, so there's no, I mean, I haven't personally seen it, but I don't see what you're basically spelling out as opportunistic bridge loans. I'm seeing it more as a necessary bridge loans. You're seeing more softness, you're seeing more like there's huge eviction issues in a lot of places. And so that's bringing our occupancies down sub 90%. And the kind of the general rule for your stabilized properties and to get like Fannie and Freddie loans and those, those fixed rate or those floaters from Fannie and Freddie is the 90-90, right? You want to see 90% occupancy for the last 90 days. And there's a lot of properties that aren't qualifying for that. And so any property that needs to be sold right now, because no one's selling if they don't have to sell right now. They know it's a down market. Why would you sell if you don't have to sell? And so those are the properties that are stabilized and doing well. Those are the ones above 90%. Those are the ones that are, cash flowing well. It's the ones that need to sell. Well, why do they need to sell? A good portion of them are in having issues. And sometimes those issues are sub 90% occupancy. So they're not qualifying. So you're having to get bridge loans just because I can't get a Fannie or Freddie off of a property that's less than 90% occupied.
But even if you could, I mean, not to play devil's advocate, but that's what I do. Even if they suddenly carved out an exception, say, look, we are going to lend you, even if you're at 87 or 88, the debt service coverage ratio still wasn't there, right? I don't know if it's there now because maybe prices have come down now to the point where your debt coverage ratio works. But back right when COVID was going on, you just couldn't get things to pencil out.
Yeah. Bridge loans typically don't care about debt service coverage ratio going in. They will have hurdles later, but going in, they won't really care. And that's why you can get that leverage way up.
The conventionals do.
Yes.
They want that 1.25 or something. I mean, they want that 1.2, 1.25.
Yeah, 1.25, 1.3. And that's why we're only getting 60, 65 right now.
Right. Yeah. That's my point. So that's why we were using bridge debt back in the day. I guess I thought that was done. But it sounds like that's still something that people are looking into because they can't get the leverage. So they're still looking at bridge. And yeah, maybe we're getting a little off topic, but this is underwriting. I mean, this is underwriting 101.
Yeah, no, I completely, and loans are the biggest issue right now. Let's be honest. You do have insurance, you do have taxes. Taxes is a whole nother thing. We kind of have the opposite issue with taxes right now. Taxes a couple of years ago was, these tax municipalities were raising it like crazy and you'd have to fight them down. Now you're kind of like, it's like the tax municipalities have to catch up with values going down. So there are these other issues, but loans are the biggest issue right now. And picking a loan, I mean, maybe I'm being too conservative, but if I can help it, I'm not doing bridge debt. Bridge debt is only out of necessity, and you're being conservative with it just because it's, I don't know what's going to happen in 2 years, even 3 years. And that's the problem with bridge debt is you have a forced event. You have a forced event happening in 3 years. And a lot of these properties that are having issues is because that forced event is coming up at the wrong time. And I'm just concerned to, our previous discussion, where are we going to be in 2 years? Where are we going to be in 3 years? Because yes, okay, our bridge loan is typically 3 years, but you got to start making plans at year 2. You can't, it's a very slow process to figure out what you're doing next. And especially 2.5 years, that's when you're basically locking in what you're doing. So I just don't want to be in that situation if I don't have to right now. And if I am, I'm being as conservative as I can with those bridge loans.
Yeah. And one of my concerns that I've seen is that, as we've been talking about on the show, like at the beginning of the year, everybody was assuming we were going to have seven rate cuts. And so that's going to affect the 10-year to some extent. I mean, it's not directly correlated, but the expectation 6 months ago was that the 10-year and therefore mortgages were going to be not about way lower, but we're going to be lower than they are today. And today, I think we're getting to the point where people are starting to think maybe we're not going to get any rate cuts this year at all. And there's some rumblings that they might start going up. So your mortgage, your debt service might be actually higher in the next couple of years and lower, which is something that would have been unheard of 6 months ago.
Yeah, the thing, the debt portion of underwriting is kind of a wild card over all ages. I mean, we could say, oh yeah, debt is going to be this, and you can plan out 3, 4, or 5 years. I don't know any time that 5 years into the future, first of all, people were even close to right, but it changes so wildly. When we look at placing debt, we try to get at the end of the day, these what you're talking about is you can get trapped. I call these value traps, where the external value of the marketplace through debt or a sell takes into account, and it may not match up with the reality of the situation. And you can lose a property over it. So you can have a property that's making money, it's cash flowing, the exact same it was when you bought it. All of a sudden now you have to refinance or you have to sell, and the marketplace is valuing it at X, and you lose the property, even though it didn't change. The cash flow didn't change, right? So I call these value traps. So the only thing to really fight against these is time. That's it. Time. You need more time. So for us, we're like, if we can, 10 years, as far out as we can get. That means in 5 years, if interest rates are really low and good, well, hey, maybe we'll refi into another 10 years, right? Or if not, we have years. We have time to go to weather the refinancing period, weather the sell, because the short-term markets fluctuate, right? When we're looking at underwriting, for us in our industry, we are looking at how we can drive that value, right, to offset any changes. Meaning that, all right, if I'm buying an asset, I want the value to go increase a certain amount, and I can measure, I call it money on the table. We have delinquencies, we have all this stuff where we can get this off. It's easy, it's not being ran properly. Then how much does that add to our bottom line? And if you're stress testing that, what is that, 100 basis points on a cap rate, right? So there's certain things you can do to try to hedge against it. But at the end of the day, the market is the market. And I don't know if interest rates are going to be in 2 years, 15% or 3. And so the only thing that you can really do to hedge against that is either increase the NOI to a point where it doesn't matter anymore, or which the market might not let you do that. So it doesn't matter. Or time that you can weather through those storms. And so when we're underwriting, you're right, the biggest factor on that future pro forma is if you have to sell, are you selling at a 4 cap or are you selling at an 8 cap? If you have to refinance, is that a 3% interest rate or is that a 10% interest rate? Will your DCR make it or not? That can be a ticking time bomb, right?
Right. And that cap rate is basically you're making that decision based off of an assumption of where you think interest rates are going to be, what you think the market's going to be, right? Because like if we think that interest rates are going to come back down even, halfway to where we don't expect them to go down to zero. No one's going to underwrite that. But if you even think that we're going to come down from, 5.25 down to 2.5 for Fed fund rates, which they've kind of said that's like a neutral rate for them, then that's going to greatly affect cap rates. And if that's our baseline assumption, you would be underwriting that cap rates are going to get better. They're going to go down. But historically, that was blasphemy. You can't underwrite cap rates going down. You have to underwrite them going up to be conservative. And so to me, I feel like most people as a base case are doing flat cap rates right now for entry and exit, because to your point earlier, I think it was Mauricio, where that, the assumption of interest rates were kind of at the peak is the assumption right now. And so it's such a fickle thing. The only thing we have going for us right now is, to me, the downside of fixed rates for long term is not as bad as it used to be. If you want to look at another reason why people were doing floaters, and when 2019 I was doing floating rates, is because there was a lot of investors that kind of got, I don't want to say screwed, but they kind of got burned by fixed rate debt. And that's because the fixed rate debt kept coming down. So they would lock in and have a 4% rate. And then when they would go to sell, the rate would be at 3%. And the problem with that is that in commercial real estate, you can't just exit a loan. It's not like residential where you're like, hey, I want to sell right now, buy a loan, see ya. And there's no consequences. Whatever loan you currently have, you have to either pay defeasance or yield maintenance. And basically that's the bank trying to make up for whatever lost revenue that they're going to lose by you exiting that loan. And so if they gave you a loan at 4% and you're paying them 4% and they have to go and replace that with a current rate at 3%, they're going to charge you a lot of money to get out of that loan. And so there was a lot of people who were getting burned by that. They would buy a property in 2017. They'd put, at that time, I think it was 5%, 5.5% debt on it. all of a sudden 2 years later, their property's gone up and massively in values because cap rates went way down, because loans went way down. They're like, oh, we should sell. And then they go and see, and they're like, okay, what's my yield maintenance calculation? And their yield maintenance calculation trying to sell a $20 million property would be $2.5 million. They have to pay the bank because rates went down so low. So the only good thing I see about that right now.
Are you talking about non-recourse loans?
Either way, either way, when you have a fixed rate loan, if you try to exit before the full term, then you have to pay some sort of defeasance or yield maintenance. And so the good thing about that is if you have a yield maintenance loan right now and you're locking in a rate at 6.5, it's very plausible, if not likely, that a couple years from now, rates are going to be lower. And if you try to exit that loan, your penalties that you're going to have to pay to exit that loan are going to be a lot less than historically they've been. And so it's not as big of an issue. You lock it in that longer term rate because the penalties of getting out aren't as big.
Yeah, we do all ours, no prepayment penalties. When depends on obviously the banks and where you're using it and how you pay it. We pay.
I mean, that's why we used to do floaters all the time. Floaters were 1 year lockout and 1% exit. Doesn't matter when you exit. So we could, after 1 year, we could be like, geez, our property went up 25%. Let's sell. And we just pay 1%. Or we could wait till year 3 and it'd be 1%, or year 4, 1%. You can get a 10 or 12 year loan. You could exit anytime along the way. But obviously we're feeling a little bit pain on the floaters right now. But at the time it made a lot of sense. You know, we didn't really predict interest rates going up this quickly for, you know, in this shorter period of time.
One of the hardest things, I think, when you're dealing with underwriting, first of all, occupancy, that tends to be a very simple metric. Not that you can predict it or the demand of stuff, but the actual occupancy level. It's going up to this, it's going down to this, and we can see how that reflects and what that will do. Rents and projecting out rents, at least in my industry, is way harder. We do not have year-long contracts. It's not necessarily set by the market like that. That's not how it works. So when we're looking at that, the revenue management piece and the rent pricing piece, that is a big deal. And that can make or break you. And so understanding the revenue management and underwriting, and based upon rates and rate fluctuations, depending on what asset class you're in, it's going to make a big difference in how you are going to analyze that over the next few years.
All right. We're getting along a little long in the tooth here, even with just 2 topics. So we're going to skip a third topic. Any final thoughts there, Jay or Mauricio?
Yeah. How come we're skipping the third topic?
I told you I didn't want to give you the opportunity to present. So
we'll let you do 2 topics next week, Mauricio.
I'm going to do all 3 next week. Actually, you guys don't even need to show up. I'm going to do the whole thing.
We get to go on vacation. Thanks.
All right, Jay, any final thoughts? You're the one who put on the clinic. So why don't you wrap it up?
Nope. I think you guys beat that horse until it was well overdone, to mix a couple metaphors.
All right. So to sum up, 2 years from now, use 5.5 as an interest rate and 5 as an exit cap. Right, AJ?
That's right. That's what we do.
Don't do that. Please don't do that.
Please don't do that.
Okay. Should we do a top 10?
Yes, please. I want to do the top 10.
Actually, I have a fun one for you guys. Oh, I think it's fun. So I'm playing off.
There's a huge difference. There's a huge difference between you having a fun one and you thinking it being fun. That's 2 completely different things.
That's true. So I'm playing off we talked about stagflation. So I'm playing off the word stag. And I found out recently that there's this thing called a stag and doe or a buck and doe that only happens in Canada. It doesn't happen anywhere else. Have you guys heard of this? Stag and doe, buck and doe?
Yeah, it's the fries with the gravy on top or something.
That's poutine, but very close. That's another Canadian tradition. We also play hockey, Jay, if you want to go there. But so this is the concept, and it really offends some Americans whenever I bring this up. But it's kind of like a rural redneck like tradition, and my dad's whole family are rural rednecks. So a stag and doe or buck and doe is basically a party that's thrown by the future bride and groom before they get married to raise money for the wedding. So they throw this big party and they invite all their friends, and the friends show up and they play games that are designed to raise money to help them pay for the wedding. And so it really offends some people who think traditionally, like, okay, like, I don't know, they're super traditional, like, oh, the dad should be paying, the dad of the bride should be paying for the wedding or whatever. But it's just a thing that we do back in Canada, and it blows people's mind. And I already told you that this is kind of a redneck thing. So once I start going through some of the games that get played at these parties, people just go like crazy that they think it. They picture, National Lampoon's Vegas Vacation, where they go to the Indian casino and they start playing those random games like guess a card and like war and all these different things. That's the feeling you get when you get to these stag and go. So I actually found a list of of top stag and doe games to play, and to the point where if you didn't believe me, I'm sharing it on the screen for anyone. And so I'll go through some of the easy ones real quickly. But there's a 50-50 draw, classic money raiser. There's prize draws, so you just buy a TV and everyone puts in tickets. There's guessing games. So like like at like middle school, you put like a 300 jelly beans in there and people have to guess. So tickets to that. There's lock and key is a good one where everyone buys a key and you see who can open the lock. It's kind of like the Squid Game. If you guys ever watched that Netflix Squid Game, this is a great one. Toonie toss. So most people won't even know what a toonie is. A toonie is in Canada a $2 coin. So in Canada, there's such thing as a $2 coin. And so basically what you do is you take a bottle of Jack Daniels or Woodford Reserve and you put it in the middle of the floor and everyone throws toonies at it, and whoever gets closest wins the booze.
I want to talk about number 6, the Great Canadian Whack-Off. What in the world is a Great Canadian Whack-Off?
That is the most fun one.
I'm sure basically it is.
It's called the Great Canadian Whack-Off. But basically what it is since these are all rednecks, you'll get a bunch of guys who are construction workers, roofers, or just DIY guys at their own house who fix up their own house. And they all think that they are the best with a hammer. So it's a very simple game. You have a stump of wood and you stick like a 4-inch spike, like a nail, and you just lightly put it in there. And then you give the guy a hammer and it's $2 to give it a try. And you say, how many whacks at the nail is it going to take for you to flush it in the stud or in the stump? And so there's usually somebody who pulls it off in 2. And then you have a whack off where they go against each other with one spike, and then whoever does it in the least amount of whacks gets the job done. And so anyway, there's and then there's some other redneck ones. So then there's card games, Find the Ace. Another great one's a measuring tape, where you take a measuring tape and you put it up in the air and you see how high you could get before the measuring tape collapses, and the person who gets the highest, they win. The case of beer hold, everyone gets a case of beer and they hold it above their head, and whoever holds it the longest keeps the case of beer.
Wow, you guys really are wild and crazy in Canada.
And then the final one's the hockey shootout. So you have a hockey shootout, you put up the targets and you shoot hockey pucks at it. And I usually wasn't allowed to play that. If you're a professional hockey player, they wouldn't let you play. So anyway, that's a thing that happens in Canada, that people throw a party to raise money and have redneck games. So if you're recently, or you know someone who's recently engaged, take on the Canadian tradition, throw a stag and doe in light of our upcoming stagflation. Do a stag and doe.
Have your whack off competition. Have your measuring tape competition at the same time.
Do it for me.
Do it for that. Only Kyle would go there. I think, Jay, if you and I were doing the top 10, we would have come up with what are the top 10 Stag's Leap vintages in wine. that would have been our top 10. The top 10 Stag Leap.
Actually, an excellent. And Mauricio, for your reference, because I know you're a bourbon drinker now.
Yeah.
Stag. Well, it used to be Stag Junior. It's just Stag now. It's made by Buffalo Trace, a very in demand bourbon as well. Very hard to find. I can't find a bottle of it. So
okay, we're going into the 4th hour of the show now.
Oh, Jay. Listen who's talking. Do you want me to pull up the first segment? What percentage of the talking you did in that? It was close to 90% of the talking. And yet when we get to the back half, when it's not Jay's topic, and when all of a sudden we're at other things, and Jay's like, "Oh,
I'm sorry. Keep going. Talk
so
more about your
long.
whack-off competition. Sorry. You're
This
right.
episode took so long. I wonder why, Jay. You talked for an hour on your segment. Okay. I was gonna say best, ask for people's best bachelor party stories for where to go and keep the stag going, but maybe we could just skip that. What do you think?
I don't know anything about bachelor parties, so
You've never been to a bachelor party, AJ?
I don't think I have.
What?
Yeah.
Oh, they're one of the most fun parties ever. I'll tell one quick story. My brother-in-law, so Ashley's brother, we took him to Atlantic City and we took him to the strip club, and his wife's name is Brooke, and we paid the stripper to put him up on stage and pull down his pants and whip him with a belt, and she was so good at it that she made it perfectly into a B on his ass. So he went home with a brand of a B on his ass from the stripper's belt. Since AJ was the only one who laughed at my joke there, AJ, you get the first plug. What do you got for us, buddy?
Yes. Thank you. Since I've done the newsletter, every time I'm not going to plug my newsletter at all. Definitely not, even though we send it out weekly. I'm not going to plug it. So check out the podcast, everybody. Go check out the podcast. We got some great new episodes coming on. Yeah, AG Osborne. Check it out.
Mauricio, what do you got for us?
You couldn't have been prepared with that. You got to make a big show of it, Mauricio.
Legal strategy. Actually, you know what? Legal strategy for everyone. First of all, those of you who got the free book from like 3 or 4 episodes ago, half of you guys have not put your info for me to send you a autographed copy of this, but legal strategy for everyone. If you get a copy before May 9th, I'm actually doing an asset protection course masterclass just for those who buy the book. So you can go to legalstrategiesforeveryone.com or just anywhere, go to Amazon to pick up a copy and then join us for the asset protection masterclass on May 9th.
And I went through this. I'll give another plug for Mauricio. I went through this when my wife was doing her book. It really helps people when they're releasing a book in the beginning if people leave reviews, especially 5-star reviews. But don't be a dick, especially if you got a free book from Mauricio. Go leave him a review. Give him 5 stars, because it does really help your Amazon rankings and all those things in order to help the author out. So if you got a free book, go leave him a review.
Thank
5
you, Kyle.
stars.
Thank you.
It's a great book. It's really helpful. So go give him that 5 stars. Jay, I'm only giving you a plug because it's probably something that is going to be beneficial to our business, because so I'm not going to stiff you on a plug.
Okay. I'll do 2 quick ones. So
Wait, he gets 2? Wait, how come he gets 2?
I could have been done by now. Go give us a review and a rating on Apple Podcasts for this podcast. See, that benefits all of us.
It's true.
I thought you wanted to go to YouTube and have a like and subscribe.
Go to YouTube, smash that subscribe button, like button, whatever it is, do that. And finally, Conference Connect. So a little project, big project that we're working on. Ashley Wilson, Kyle Wilson's husband's wife, is running that one. Go to conferenceconnect.com, sign up. We've got 8,000 speakers on the platform. Find conferences that you want to go to, that you might want to speak at. Follow your favorite speakers and see where they're speaking, and conferenceconnect.com.
Once again, I'm always going to plug my wife. Go check out her socials, because she's feeling down in the dumps right now. She, as much as I want to make a joke about it, but she fell off her horse pretty badly. I had to take her and go get x-rays. Luckily, the x-rays are negative, but she's still pretty sore, isn't moving around a bunch. So go make her feel better. She put out a bunch of, while she was laid up, put a bunch of funny memes on her page for Badass Investor. Go check it out. Laugh at her memes. Put a little heart on that. Actually, I don't know if I she's pretty sore up. I don't even, if I can't even plug her tonight. So I'll probably, she's going to go up to bed early. I'll probably just go to the back stump and do a solo whack off. Probably
do a whack off.
Say you're Canadian.
So I'll plug the Canadian whack off, because that's tonight. My wife's probably going to go to bed early because she's on a lot of drugs, and I got to pass the time, so I'll probably go do that tonight. So I don't know about you guys, but my drink is gone. I got to go hit the head. We all back next week, or is that the week you're gone, Mauricio?
I have no idea. Oh, I'm around.
No, we're all here.
We're all here. Awesome.
Yeah, Monday I'm out because it's my daughter's 10th birthday on Monday, but we'll be back on Tuesday.
Oh, 10. Wow, double digits. Scary, man.
Double digits. 10 years old. Can you believe that? Don't worry, I'm not gonna dislocate my ankle by playing, soccer with my 10-year-old. I'm not that lame.
Good for you, old man.
Okay, we really need to end this. My wife has been gone for 5 days. She's getting home in 10 minutes, so I have 10 minutes to clean up the house.
Is that why he's so grumpy? Jeez,
Yes,
you've been like above Mauricio level grumpy for the back 2 segments. It's usually Mauricio who gets grumpy, and you just like took right over there. And actually, Mauricio's in a pretty good mood. I appreciate it, Mauricio.
Yeah.
I need to clean the house before she gets home. 10 minutes.
Anything else you want to talk about, Mauricio, before we go?
Goodbye.
I've got. I'll see you guys next week.
All right. We'll see you next Tuesday.
See ya.